Hi everyone. We're going to cover Chapter 9 for business organizations tonight. And this chapter is focused on the corporate financial structure. So, this, along with chapters 10, 11, 12, and 14, will be the subject of your final examination. So, we talked a little bit about the basics of corporations, forming corporations in the last chapters. And now we're going to get into more of the details regarding how it runs financially, what are some of the important financial aspects, how does it continue to raise money and be successful in this chapter. So there are some, just to kind of go back to the introduction, but the purpose of a corporation generally is that it intends to make money. So how does it do that? Well, it can either, in order to raise money, it can either sell stock to its investors who become shareholders or bondholders, as we're going to discuss, or it can borrow money because, as I mentioned before, a corporation is a person and a legal entity can borrow money. So, when stock is sold to investors who become shareholders, there are securities that are then created. A security is just a share or some financial interest in the property, and shows that the corporation is obligated to pay that money, whether it be, the value of the share or the money that's been paid back. So security is the larger overall term here that I want you to keep in mind. But under that, there are two types. There's equity security and there's debt security. So equity security it represents an ownership interest. An equity security is basically just a share. It's a percentage, an aspect of the business that a shareholder owns. A debt security, on the other hand, is typically referred to as a bond, but this is where the company has borrowed money and says, well, we owe this debt essentially, as opposed the bondholder is not an owner of the company in the way that a shareholder would be. So I should just mention a shareholder can also be called a stockholder. That is an interchangeable term for one who owns an equity security in the form of a share. There's also aspects of raising money by virtue of equity capital or debt capital. And equity capital is money that is received by a corporation in return for an issuance of a stock. So the security, this goes hand in hand with the equity security. The interest that the shareholder has in the company is the security. That's the legal obligation for the company to pay. What the shareholder gives in exchange for that is the money to buy the share. And that money that comes in is the capital that is received by the corporation. So if you think back to contracts, this is basically the consideration that goes back and forth. The shareholder gets the share or the security, the business gets the capital, but there is an obligation on both parts. The shareholder's obligation is relieved, obviously, once it pays for the share, but then the company's obligation is to cash it out, basically, if the shareholder ever wants to sell. Similarly, with a debt security, the flip side of that is debt capital. So the money that the corporation receives in return for issuing a debt security or a bond is considered debt capital. So they're just kind of two sides of one coin, essentially, when we're talking about equity security, equity capital, and debt security and debt capital. So a bondholder is one to whom a debt is owed by a corporation. And I want to just, again, try to distinguish between stocks and bonds for a moment. There is, if one is to buy a share or stock in a company, again, this essentially, this person then becomes a part owner, has a financial interest in the company. And there can be a lot of potential for great return. On the flip side, there can be a lot of potential for risk. If I buy a share of Apple for $100 and they have a really great quarter, well, I could get a great return on my investment. Similarly, if the company, is busted for throttling all of our phone batteries, basically when a new release of the iPhone comes out and shares tank, well, then I've taken that risk and I may not get my full $100 back if I go to sell. I may lose money on my investment. So that's the trade-off when it comes, and then the risks and the rewards when it comes to stocks. Whereas bondholders, those are a more secure investment, because bondholders are saying, like, look, I lent you this money, you owe me this money. It's effectively a loan. So this person is a creditor to the corporation, not an owner. And so if a company were to fold, then the bondholders are going to get paid first before any money would be distributed to any sort of shareholders. Just like when we've talked about with the concept of winding down, when we say that a company has to, gather and sell off all of its assets and then satisfy its debts, well, bondholders are part of those debts. So there's less risk to own a bond, but you're not going to potentially reap the rewards that a shareholder would reap. Also, too, if the company decides to issue a bunch of additional stocks after you've bought shares, it doesn't dilute your percentage of interest. If you're a bondholder, you're owed whatever you're owed. Whereas a shareholder who maybe owns 50% of a company on March 1st, and then the company on March 2nd issues a number of other shares, authorizes new shares, then that might reduce that person's percentage of interest. Another key term to keep in mind is dividend. And dividend is essentially a distribution of corporate profits. So, money that shareholders are entitled to receive on, it can be a regular basis. It depends. The company can establish when it wants to pay dividends, if it's going to pay dividends. But that is, if you are a shareholder, and again, if you have a certain number of shares, you may be entitled to dividends or profits based on the amount of shares that you own. And as we're going to talk about when we talk about the different types of stocks, the type of dividends or how they're paid can vary as well. So when we talk about the types of stock, I mentioned this, I think, briefly in the last chapter, but there are two major categories of stocks. There's common stock and there's preferred stock. And again, if the company is inclined to have these two different types and it plans to issue stocks, those designations need to be indicated in the Articles of Incorporation. And the Articles of Incorporation have to indicate the maximum number of authorized shares. Otherwise, the company cannot issue more than that without amending its Articles of Incorporation. Now, authorized shares, just to point out, are different than authorized shares are just the maximum that the company can issue. The company doesn't have to issue all of the amount of authorized shares. But once shares are authorized, then they become outstanding shares. And And the board of directors will typically decide how many shares will be issued and what the price will be. But recall from last chapter, the articles of incorporation will set a minimum price, and that is considered par value. So the board of directors can certainly feel free to vote to sell for, issue shares for a higher price, but they can't go below the par value. So common stock is just kind of the default ordinary stock. There's no special privileges. There's no special rights that go along with this. And there can be subcategories of common stock, but everyone within a category has to get treated the same way. But there's nothing really special about it. It's ordinary stock. Preferred stock, however, is kind of a higher level of stock. And typically it will have certain rights and privileges that go along with it. If a company wants to issue preferred stock at some point, it needs to identify this in the Articles of Incorporation. It needs to spell out this intention. And it also must describe, well, what are the rights? What are the privileges going to be? Are there going to be limits to the preferred stock? All of this needs to be spelled out in there, or they cannot be issued. And so that is very important, again, when we talk about the pre-planning of what the company is going to look like. If the company has any thought about wanting to do this, maybe down the line, this is something that needs to get spelled out in the Articles of Incorporation. So the types of rights that one might find in preferred stock, I do want to point out while I'm thinking about this. Okay. Page 135 of your book has a nice chart on this just to compare. So there are differences in these categories, whether we're talking about common or preferred stock. So generally, common stockholders are generally entitled to, the default is usually that they get one vote per share of stock that they own. For preferred stock, there may not be any voting rights. That's rare, believe it or not. The Articles of Incorporation have to indicate whether preferred stockholders or shareholders will be entitled to any sort of vote. And if they do, will it be one vote per share? It has to be spelled out. So, if you've ever owned any sort of stocks at all, you may receive documentation that say, there's going to be an annual meeting and we might be voting on these issues and you have the right to send a proxy. I get letters about this every year through MetLife because I own a policy through MetLife and I'm considered somehow kind of an owner of that. But in any event, I don't actually do any voting, but it's a similar concept. It's like, I get a say. Whether I exercise it is one thing or another. So if within the common stock, if there are subcategories, like if there's common stock A, common stock B, common stock C, if there are going to be different types of voting rights rules, like maybe A gets 2 votes per share, but B and C only get 1 vote per share, that's okay. The company can do that, but the company cannot treat shareholders within one category differently. So everyone in common stock A, everyone who owns common stock A shares has to be treated the same. Same within B, same within C. So that is very important that they be treated the same within a category. When it comes to distribution rights, which, essentially just means paying out dividends, which in large part is within the discretion of the board. It's not required that dividends be paid, but the board can vote on that depending on how strong a quarter may have been, or how strong a year may have been. But when it comes to the rights of distribution, common versus preferred, generally common stock shareholders have no right to distributions. Um, these are, this is going to be totally at the discretion of the board. And again, once we'll talk about the different tests for them being paid, but paying the dividends can't bankrupt the company. So the company has to be in a good financial position to pay. Whereas with preferred stock, usually distribution or dividends are guaranteed. They might be cumulative. So, if maybe the company doesn't have the money to pay dividends in one quarter, but they were earned, they would be held off until a later period. Just kind of carry over and say, okay, we didn't pay your $50 per share in this quarter, but next quarter we'll pay that out with whatever other dividends are accrued. When it comes to liquidation, so, when the company is winding up, selling all of its assets, gathering all of its finances together in order to determine, paying all of its creditors, that sort of thing. Common stock shareholders are entitled to receive any assets after distribution to creditors and preferred shareholders. So, I should have done that the opposite way. Preferred stock shareholders are entitled to be paid out once the company has satisfied all of its debts. Once it's paid its creditors, which includes bondholders, then preferred stock shareholders are paid out, and they then, if there's anything left over, common stock shareholders can be paid. So common stock shareholders are really kind of at the bottom of the totem pole there, and only if there's money left after liquidation. Common stock shareholders have no right to conversion, meaning they can't convert their common stock into preferred stock. But preferred stockholders have generally have the right to convert their preferred stock over to common stock. It's not to say that it might not always be beneficial, but if they ever so choose to do that, they are generally given that option, to do so. And then redemption rights, this is just the right of a shareholder to say to the corporation, you need to buy my stock. You need to buy it back from me. Or the right of the corporation to say to the shareholder, you need to sell it back to me. So those are two different, there's terminology for those two actions. A call is when the corporation requires the shareholders to sell their stock back. So it's like calling the stock back to the kitty, for lack of a better term, like putting it in the, so to speak, bank of shares. And a put is, well, maybe not quite the opposite, but it's when the shareholder can require the corporation to buy stock from the shareholders. Common stock shareholders have no right of redemption, whereas preferred stock shareholders can sometimes be forced to sell their stock back to the corporation, which is a call, or force the corporation to buy their stock back at an agreed upon price. So that would be the put. So those are main distinctions between the category of common stock and preferred stock. And again, I think the chart on page 135 is really nice. It breaks it down very easily. So I would also just note there is the concept of treasury shares, and this would be shares that the corporation gets back from shareholders. So it reacquires the shares. These are sometimes considered, they're authorized shares, obviously, because they were previously issued, so they're authorized. But instead of going back into kind of the initial or the bank, they're considered treasury shares. So they can, believe it or not, be sold for less than par value. But nobody has a right to vote based on these shares. There's no dividends paid on these shares. But they are still part of the total number of authorized shares. So some states require reacquired shares to become treasury shares, whereas other states are just fine with, hey, listen, Apple, if you reacquire these shares, they're just going back into your authorized bank, and then you can just sell them like any other shares. So that's going to be different depending on the state. Excuse me. Again, this is just a several slide chart. I like the chart in the book better though, because it's all in one, so you can see it kind of next to each other without having to be spread apart. Okay, so moving on from the types of stock, we're going to talk about debt securities for a little while. And an unsecured debt is a debt that is taken on and there's no collateral pledged for it, right? So the corporation doesn't have to put the building up as collateral to the bank in order to get a loan. All the corporation does is signs a contract. I mean, it signs a promissory note saying, yeah, I'll pay you back. And that's enough in and of itself to get the loan. To kind of put this in non-corporate terms, for anyone who's ever taken a student loan, we sign promissory notes to take student loans. And it's our obligation that, yes, we're going to pay this back, once we're done with school and once we have an income. So I'll speak for myself for sure, but I would say most people are not putting up any collateral to get school loans. They're not having to say, here's the deed to my house in the event that I default, anything like that. So that's an unsecured debt. So again, one who has lent money to a corporation via an unsecured debt is not an owner. There is no ownership interest in the corporation. This person is just a creditor. This person can't vote in any of the measures or motions that are put forth. There's no right to dividends. It's just a traditional loan, for lack of a better term. The promissory note also should definitely spell out, though, like the repayment time, the interest rate, etc. It should be very clear about when the corporation will pay everything back. Now, a secured debt, on the other hand, is money borrowed that is backed by collateral. So again, if the company says, all right, we want to borrow $10 million to expand, and a bank says, that's great, we'll lend you this money, but you have to understand what a risk this is to us. So what we need is your, we need your building, your office building, to be collateral. And so if the company defaults, then the bank could seize the building, could sell it, and it could hopefully satisfy what's owed, the debt that's owed. I mean, an example of, collateral debt, or, I guess it's collateral debt. I mean, if you think about someone who has to make bail and they don't have the money, they will sometimes have to put down collateral to basically have a bondsman put the money up for them. It's not quite the same example, but it's that property is being held in the event that someone decides, well, I'm not paying this anymore. So there's something that the creditor can get in order to satisfy the debt, if it comes to that. But the document that's created in order to establish and memorialize this debt is often called a bond. And so we'll say, all right, this is how much you borrow, this is the principal, this is the interest that's going to be paid out over a period of time, the date of repayment, describing the property that's being pledged to secure payment of the loan. And if there's any other rights that the bondholder or lender is getting, that should be spelled out in there. If the collateral is in fact real estate, then the document is considered a mortgage bond, and the corporation is required to pay real estate taxes and keep the building insured and in good condition in the meantime. The corporation can't say, well, whatever, what we're going to do, we're going to get one over on this bank. We're going to borrow that $10 million and then we are just going to throw our hands up and we're not going to do anything with that building. So if we decide to skedaddle and get out of here, then haha, bank, you've just been hosed. You're getting this really crappy building. Well, they can't do that. They're not permitted to do that. They have to maintain it as if it was a valuable asset of their own. And if it's personal property that's being put down for collateral, then the document is a security agreement with a requisite financing statement that's all filed with the Department of State. And so we covered that in the contracts class. So if you want to check back and with the contracts book, that's all in there. But it's also addressed starting on page 137 of your business organizations book as well. So it's in both. But certainly the contracts book covers that in more depth. So just to quickly compare the two, equity securities, stocks or shares, versus debt securities, which are bonds. A shareholder or a stockholder is an owner of the corporation and can vote and receive distributions if that's financially permissible. Whereas a bondholder or creditor is just that. It's just a creditor, and just the only thing that person or that entity is entitled to is repayment of the debt, obviously with interest. Both stocks and bonds create or bring in money for the corporation. And that can be for a lot of different reasons. Expansion, covering expenses, whatever it might be. But regardless, both are done in a way to make money for the organization. Stocks are, when additional stocks are issued, they dilute the interest and the power of existing shareholders, whereas the company can take on, maybe it already has 10 loans out. If it takes 10 more loans out, it doesn't dilute the promissory notes, it doesn't dilute the obligation for the company to pay back those first 10 loans. Those folks are still entitled to their money back. Their interest in getting repaid is no less than it was the day before. So with that, again, like I said, with debt securities, there is less of a risk. That is one incentive to having a debt security is, generally a bond has usually a higher interest rate than a bank. A lot of times bonds will have a provision in them to say, you can't pay it off early because it would reduce the interest that you're expected to receive. So sometimes that is, appealing to the lender, the bondholder essentially. So they might like that. Like, yeah, well, if this is going to be a $10 million loan with $1 million of interest over the time, I feel pretty good that I'm going to get that amount rather than the loan being paid off quickly. Typically, debt securities can be converted into equity securities, making the bondholder now an owner or shareholder. That is a possibility generally as well. And the there are ways in which, if negotiated, when the bond is being sold, the company, or I should say that the bond holder, soon to be bond holder, can insist, like, I'll lend you this, or, I'll buy this bond and effectively lend you this money if you agree to prioritize my debt over the debts of others, which would be subordinate or junior debts. And if that is, that can be something that really appeals to someone who's going to lend quite a bit of money to a company via a bond. They might say, well, if things go south, I want to know that I'm going to get paid off first. So that can be an incentive to infusing a company with cash via a bond versus buying shares. So just a few other comparisons, and these are also on this chart. All in one is on page 139 of your book. But we did essentially cover these as well, the differences. Okay, so now we're going to turn and talk about taxation, which I'm sure is everyone's favorites. But I think we can get through this pretty quickly because we did talk about some of this in the prior chapters. We started hinting at this. So generally, corporations are subject to double taxation. And again, what that means is the corporation pays now it pays at a 21% flat tax rate. And then any dividends or distributions that are made to the shareholders, any profits they receive, they pay income tax on those distributions at their applicable tax rates. So if someone is, someone has shares and they get distributions, but they're only in a 15% tax rate, then they pay a 15% tax on it. Whereas somebody who is in the 28% tax rate, they pay a 28% tax rate on it. But this is after the company has already paid taxes. Now, corporations are, when I talk about the double taxation and the 21% rate, I'm specifically talking about federal tax. That's the federal tax rate that went into effect with the Tax Cuts and Jobs Act of 2017. So that went into effect on January 1st, 2018. Prior to that, it was 35%. It was significantly different. So we don't have to, if you have an older book and it indicates that, I want you to be very clear, look up the 2017 Tax Cuts and Jobs Act, because that could really skew the information that you have. Okay, so if you do not have the current edition of the book, which is the 6th edition, please know that the information you have may be incorrect. There is, I think, a nice chart or figure, on page 141 of your book. And these are tax rates for individuals beginning in 2018 through 2025. So it just, like I said, if somebody makes $30,000 in a given year, and that includes the shares that they received. Let's say they make $30,000 from their their job, and they make $5,000 in dividends, then they would pay. They're basically in the 12% tax bracket. So the figure has it kind of all broken down because you don't actually pay like a true 12% or whatever the percentage is, because you pay a certain amount plus a percentage over that amount. Again, this is why I'm not an accountant. This is why I've hired someone to file my taxes, prepare my taxes for me, because when I tried to do this myself to figure out what I was going to owe, my head almost burst. So by all means, if you feel like figuring out your taxes, the figure on page 141 is a great place to start. Okay, so One way that sometimes corporations will try to want to avoid double taxation. And we've already talked about the fact that depending on the corporation, if it qualifies to be an S corporation, then it can decide to be, say, well, we want to be taxed as an S corporation and only just basically have the distributions and the profits pass through to the shareholders, and then they pay taxes. So the corporation doesn't pay its own federal taxes. Corporations can also try to avoid double taxation by taking on debt financing, because if they pay interest to creditors on loans, then that's a deductible expense. Corporations get to write off an enormous amount of expenses. So even with the reduction of the tax rate from 35 to 21, I mean, there's the corporations are not, there wasn't necessarily a trade-off to say, okay, well, you're not going to be able to write off as much. They still can write off quite a bit. Just like you would maybe take you itemize deductions on your taxes. Well, corporations effectively do that and help then reduce them what they have to pay. So whatever their adjusted gross income essentially is. But they have to be careful not to do too much of that with debt financing, because because the IRS might look at a corporation and say, your debts are, if they're just disproportionately high when compared to the equity, that's considered thin capitalization. And the IRS looks at that and basically says, well, you know what? This seems like it's a way for you to just try to, take on so much debt and pay so much interest. Sorry, my cat's being a pain at the door. But in any event, the IRS might say, well, no, we're going to disallow the interest deductions. So if it's legitimate, that shouldn't be a problem. But if a corporation is trying to be sneaky about this, then the IRS may come in and say, no, you cannot do that. You have to actually, you're not going to be allowed to deduct those expenses. Similarly, corporations, if they are holding back earnings, they're not paying dividends, and it's deemed to be kind of unreasonable. Like, for example, it would be reasonable for a corporation to say, listen, we're not going to pay any dividends this quarter because we have a big expansion plan. So we want to make sure we have enough capital on hand that if we pay all of our shareholders, we're not going to have the appropriate funds to be able to move forward, essentially. So if they're holding back earnings and they're trying to retain earnings beyond what's actually a reasonable future business need, then the IRS may impose an accumulated earnings tax and say, well, because you're just holding on to this and you're not passing it through to your shareholders who would then be taxed on it, we are going to penalize you, essentially. And the reason for this earnings tax, this penalty, is to encourage distribution of dividends. Because again, if those dividends are then paid out to shareholders, then the IRS is taxing those shareholders on the monies received. So remember, the IRS is trying to make sure that it collects money. It wants to tax as much as it can, and so it will do so in whatever way possible. And then tax inversions. This is when a company would move out of the U.S. into a country with a lower tax rate in order to reduce its U.S. taxes. And we saw more of this before the change in effective in 2018. And so a lot of times, what would happen is U.S. companies would they might merge with a foreign company, or they, would reincorporate somewhere else outside and become a foreign corporation. And so the government was trying to crack down on that essentially. But I think there's less of that now given the change because, a lot of the talk of the tax law that was passed was to try to encourage more business in the U.S. and make it more of a desirable place to do business, with the thought being that if corporations were being taxed so heavily, they were not going to want to be U.S. businesses. So that was the trade-off there. There is a nice figure that's on page 142 and 143 of the book, which really it summarizes the key provisions of the 2017 Tax Cuts and Jobs Act. So again, if you have an older version of the book, you will not have this figure in there. But it is, I think, a nice summary. Just there's some indications about, other pass-through companies, but also corporations. There's the most of what's on the figure pertains to corporations. So, in a nutshell, the key features of corporate finances are that, again, to raise money, corporations can either issue stocks or shares, which are equity securities, or can issue bonds, which are debt securities, basically just loans. If they're going to issue any shares, those shares have to be authorized by the Articles of Incorporation. They cannot sell the shares beyond or below the par value, except as we talked about with the only exception, I couldn't think of the word, exception to that is with treasury shares, but that's not the norm. Just any new share that's being issued cannot be sold below par value. If a stock has no par value, then it can be sold for whatever amount it wants. And corporations may have more than one class of stock. They can have common, they can have preferred, and they can have different subcategories within those two main categories. But everyone within a specific category has to be treated the same way. Debt securities may be unsecured, or they may be secured by personal property or real estate, which is just collateral. And again, corporations are subject to double taxation, with some exceptions of how they can try to avoid that. And that is it. So if you have any questions about Chapter 9, as always, please let me know. And otherwise, I will get this out to you along with Chapter 10 shortly. Have a great week, everybody.